Greetings and again, welcome. My name is John Smigelski. I'm a member of the steering committee of the California Alliance for Community Energy. The topic today is solar incentives are still alive. Who can still qualify under the One Big Beautiful Bill Act and how? I like calling that One Big Beautiful Bill personally, but so be aware that we will publish today's talk and Q&A sessions. So please save any confidential or strategy questions for the follow-up session, which we will have next Thursday at January 29th, 12 to 1. The same Zoom link will work for that call. Our mission statement is the California Alliance for Community Energy envisions a community-based and democratized energy system which promotes affordable, resilient, local renewable energy resources, prioritizing low-income communities that historically suffered inadequate access to the essentials such as affordable energy and healthy community. Our speaker today is Jose Torre-Bueno, President of the Center for Community Energy and the steering committee members. Jose, please tell us about these solar incentives that are on life support.
You should be seeing my screen now. And the topic is what incentives are still available and how to collect them. And I will make a quick disclaimer that I'm not a tax attorney, nor is CCE or the CACE. So I can inform you about the law and how complex it is. But at the end of the day, any filing you make should be done with the advice of your tax accountants and attorneys. But having made that disclosure, let's go forward and talk about this. So on July 4th, 2025, the president signed what was called the One Big Beautiful Act, which was clearly intended to suppress renewable power in favor of fossil fuel. It was passed in a great hurry with a very narrow majority, and many amendments were introduced by the Senate and not reconciled with the House. So it's kind of a crazy quilt of exceptions.
You know, we need to make sure that happens in as much of the state as we can.
Can we mute whoever's on there? So there's a whole series of exceptions rules and the timeouts of the sunsetting of various incentives is different and in complex ways. So what we're going to do here is explore the ways that businesses, renewable energy companies, nonprofits, public entities, and whoever can carry on with renewable energy projects despite this hostile environment. And we're going to focus on smaller projects, not utility scale projects, but the kind of projects that you might do on a building for a particular entity or a community project. The rules are more complex and restrictive for larger projects. If you're interested in a larger project, reach out to me. So timelines and incentives, because this is all based around timelines. First of all, to put it out of the way, residential timelines. The residential incentives ended hard on December 31st of last year. There's no possibility for an individual taxpayer to get any more incentives. Furthermore, the Congress thought of the loophole of a company leasing you solar power, and they wrote a rule that said that a leasing company can't buy solar power, collect the incentive because they're a corporation, and then lease it to you. So leasers can collect the incentives on batteries for reasons I'll get to, but not for solar. PPA companies, because in a PPA, they're not selling you the equipment, they're selling you the electrons. They can still collect the incentives till 2027. The incentive for home EV chargers, strangely enough, doesn't expire until June 30, 2026. That's only for rural low-income housing, but the definition of rural is broad enough that a lot of luxury homes are within the rural districts. And there's a map that you can use to find that, which I have the link for here. And I can, when you get this as a distribution, you'll have that live link. Anyway, so that's But that's pretty much it for residential. Direct residential is pretty much over. However, non-residential is very complicated. A PV project which starts before July 4th, 2026 is what's called safe harbor, which means it has until 2030 to finish, and it can still collect the incentives that were put in place by the Biden administration. A project that starts after July 4th, 2026 must be fully operational by the end of 2027 to collect the incentives. So a project that starts earlier can finish later, and a project that starts later has to finish earlier to collect the incentives. I know it sounds crazy, but that's the way the rules wound up. So what does it mean? A project under 1.5 megawatts, the definition of start is to spend 5% of the project cost, and I'll say more on that later. The upshot is this creates an urgent opportunity for organizations to preserve their rights to collect the PV incentives by taking action right away. And by the way, now I'm talking just about photovoltaic because the battery incentives were preserved until 2033. So you have much more time to worry about batteries. And we're not talking about trivial numbers here. The base incentive is 30%. And there's very complicated rules about prevailing wages for bigger projects, but smaller projects are exempt from those. Furthermore, there's a 10% incentive for being in an energy community. I'm going to go into more details about all these incentives in a minute. There's a 10% incentive for using domestic materials. There's a 10 to 20% incentive for projects by nonprofits or in low-income areas. So in principle, a project could get a 70% incentive for the government. And we'll go into detail about all of these. Who qualifies? Any business of any type, C Corps, LLCs, S Corps, sole proprietors, any non-tax paying entity, nonprofits, governments, tribal governments, public agencies, NCOs, anybody who's not an individual taxpayer can still collect the incentive if they move quickly enough. So I said before July 4th, what constitutes start? That's the critical question. The IRS gets to define what it means to start a project. And the current definition is when 5% of the cost of a project has been spent, the project is legally started. And this is actually from law that predates the One Big Beautiful Horrible law. This concept was first defined in 2013 with respect to wind projects. It was extended in 2018 to solar projects, and the concept of safe harbor was introduced. The concept of safe harbor is that once you started the project, you're considered to have established the date for which the rules apply to you, but you have to be working on the project. But the concept of safe harbor is that if you finish the project by the 4th calendar year after you've begun it, it's considered that you don't have to prove that you were working on it continuously. So if you start a project by July 4th of this year, then as long as the project finishes by the end of 2030, you're considered to be under the rules that were in place on July 4th. Now, you'll hear people say, oh, it doesn't count anymore. The rules that was taken away. It was taken away for larger projects by an order by the president trying to make it harder to do solar. But when the IRS issued the regulation, making it harder for large projects to establish a start time, essentially they said a large project has to actually, be digging dirt to establish a start time. They specifically and explicitly exempted projects less than 1.5 megawatts. So anybody who tells you that a rooftop project can't establish a start time without doing physical work is misinterpreting the law. For smaller projects, any cost that is part of the project, that is, can be capitalized as part of the project cost, does count toward the 5% spend to start a project. So that doesn't count, for instance, land acquisition or a building, but it does count planning and design costs if they're for that project. It counts work done by in-house staff, but only if that work is capitalized. If the work is absorbed in ordinary overhead or daily payroll, then it doesn't count. So that makes the accounting a little harder. Contracted work is the cleanest because then you have an invoice that shows you spent money on a certain day. You probably want to incur a little bit more than 5% because the way the rules work, when the project finishes, the spend before July 4th has to be more than 5% of the final cost of the project. If it turns out that you spent, 4.999% of the cost, but you had a cost overrun, then you lose the entire incentive. So at that point, you have no choice of either de-scope the project or, if you've been smart, spent more than 5% before July 4th. So another way to have sufficient spending before July 4th to establish that the project is started is to buy some hardware. If the planning cost doesn't bring you over the 5% threshold, you can buy, identify some piece of hardware, hopefully an expensive and small one that's easy to store, and get hold of it and establish that you bought it, and therefore that adds to the cost that you established. Now, it has to be a real transfer of ownership. It can't be a paper thing. It can't be just something that a manufacturer says, yeah, we promise to deliver some solar panels a couple of years from now. It's best if it's actually stored on your site. If the manufacturer says, we sold you these things and we're keeping them for you, the IRS is going to question it because there has to be not just a promise of future delivery, but real physical objects that are your property. So if it's being stored for you, it has to be, these objects with this serial number are your property. The best thing to do is to have a third-party warehouse and deliver it there, and there's a bill of lading that says these were delivered for so-and-so's property. There is a quirk in the law which could be highly useful if there's a rush to get things done in July of this year and stuff is back ordered, which is that if you order something and it's back ordered, but you've paid for it, and on the basis of the seller's representations, you have a reasonable expectation of receiving delivery in 3.5 months, then for legal purposes, you can count that as having been spent on the date you paid for it. And that may come in very handy if there's a big rush of people trying to establish that they've spent 5% before July 4th. And the interesting part is, if they fail to deliver in 3.5 months, you're not losing your date, because the question is not whether it got delivered, it's a question of whether you had a reasonable expectation of it being delivered. So that's something to keep in mind. So details of the incentives. What do you have to do to get all this money? Because in some cases it's a lot. The easiest one and the most important one is energy communities. Biden's Inflation Reduction Act established the concept of energy communities, which was as advertised, areas impacted by the loss of coal plants, but it's also any area that has unemployment and had significant fossil fuel employment. And the definition of significant was not very high. It turns out most counties in California qualify as energy communities on the basis of there was some employment in handling fossil fuels, mostly oil. So Los Angeles, San Diego, pretty much 75% of the area population of California is in counties that qualify as energy communities. You know if you're an energy community if you look at a certain table that's published by the IRS. And if you start a project while your county is in that table, then you get the energy community adder automatically. It's the only qualification is you be in a county and the project started or finished in a year when your county is in that table. So the new table is going to publish June 26th. Right now, all these counties are in that table. If you start before June, well, that gives you a reason to start even earlier. You're guaranteed to get the 10% energy community adder. So which means the base incentive is 40%, which is serious money. for a project, now that's assuming you're either under 1 megawatt or paying prevailing wages. There's much less, in general, all of these incentives, you get much less if it's a big project and not paying prevailing wage. Next one, domestic content. One of the goals of this act was to encourage domestic production. And so they have the concept of domestic content. And it's a little bit complicated because it's got two phases. All iron and steel structural parts have to be domestic to get this incentive, meaning the ground mounts and carports. But rooftop racking doesn't count as structural in this context. The remaining components, only a fraction have to be domestic to get the domestic content adder. The fraction changes. In 2026, it's 50%. And after 2027, it's 55%. Again, if it's a small project, you don't have to have prevailing wage. If it's over 1 megawatt, you get much less than 10% unless you're paying prevailing wage. Importantly, the law recognizes the concept of a fractionally domestic because many things like solar panels are made in many different countries. So they'll be assembled in the US from cells made in China or something. And since it's virtually impossible to get a manufacturer to tell you what fraction of the cost of this thing came from work that was done in China versus the US or whatever, the solution they came up with is they published this table. And the concept here is that the IRS has done some kind of a statistical study, and they've decided that for a typical solar project, and they've classified it into different kinds of projects, this is the table for rooftop projects using microinverters. And they've decreed that you can assume that if you're doing a rooftop project with a microinverter, the cells inside the solar panels represented 31.1% of the value of the project. And the DC printed circuit boards in the inverter represented 7.8% of the value of the project. And you don't have to get the manufacturer to tell you what their internal price structure was. All you have to get them to tell you is where they got the different components. So in this example that I've made up, let's imagine that we're doing a solar project and we've bought some solar panels and the manufacturer has told us that, well, the cells came from China, so they're not domestic. So we don't get any credit for that. And the frame came from China, or maybe they're sending them to Malaysia to be put in the frames or whatever, right? The front glass wasn't domestic, but they sent it to the US to be finally assembled, and they used, American glue and an American back sheet and an American edge seal. So for each of those, we get to add the percentage that the IRS has decreed. Okay, good. And then assembly has a funny thing. Unless all the components are domestic, you don't get to count the assembly, even if it was assembled in the US. Okay. Well, let's assume in this case that the printed circuit boards and all the components in the inverter were domestic, so we get to count the domestic fraction of assembly. And let's assume that our racking was all domestic. So we carry over, the percentage that we count for everything that was domestic, and we add it all up. And in this made-up example, I have a product that was 53% domestic. Remember I said that in 2026, if you're 50% domestic, you get the domestic content bonus. So if I did this project in 2026, I'd be able to say this was a domestic solar array and ask for the 10% bonus. But in 2027, the required fraction to be a domestic content bonus rises to 55%. So this same project done in 2027 would not get the bonus. So that's a reason to start the project in 2026, because what counts for the year of the credit is the year you started the project. So if this project started in 2026, even if the panels were bought in 2027, it would get the bonus. But if the project was started in 2027, it would not get the bonus. It's that complicated. I didn't make this up. Anyway, another complicated one. And an even bigger one, though. there's a concept of a low-income community bonus credit. And this one isn't automatic. There's only so much, and you have to qualify via a lottery. And there's 1.8 gigawatts of incentive to give out. And first of all, it's divided into categories. So some of it is for low-income residential, some of it is for low-income, meaning low-income areas, low-income non-residential, tribal, multi-unit housing, community solar. Each of those gets a certain number of megawatts. And then within each of those, they take all the applications. And first of all, they classify them according to, is it an application by a nonprofit? Is it an application that's in a impacted area? There's a map of areas that they consider low-income areas. If it's both of those, then it gets first pick on each of these, for whatever category it's in. If there's not enough in that category, then there's a lottery. If there's enough in that category, in other words, if the applications for, say for community solar, the projects that qualify as both nonprofits and in impacted areas, the sum of them was under 800 megawatts, then everyone would get funded. And then they look at the ones that were one and not the other. And if there was anything left over, they'd go in a lottery. And then finally, the projects that are neither, if there's anything left over, they go in a lottery. So, and historically, projects that were both by a nonprofit and in an impacted area have a high win rate in this thing because of this preferential treatment. Now, the other thing about this, though, is the deadline is very close. The deadline is March 3rd. You can put it in later, but it has almost no chance because the first drawing is March 3rd, and it's likely to fill all 1.8 gigawatts by then. However, the good news is that the application is very simple. The application is nothing but saying, I have a site, I have a contract, and this is the size of the array. There's no requirement to have any detail about what you're planning to build. So if you're the right kind of organization, this is probably worth taking a shot at. So, having talked about the good news, you've probably heard about how FEOC is going to make everything so difficult. So what is FEOC? FEOC is the concept of foreign entities of concern. So the bill created the concept of these foreign entities of concern, which are countries that were trying to discourage the importing of energy materials from. And there's a list of countries, including like Iran and North Korea and things. You know, you're not going to find any North Korean solar panels, I assure you. Effectively, it means China. And it means that any project that uses too much material from a FEOC country or from a FEOC-controlled company, and part of the gotcha here is there's complicated rules about how the FEOC-ness of companies sort of percolates down via licensing agreements or ownership things. So there's very complicated rules about the certifications that vendors have to give you. And it's very important that you keep all these records when you come to claim the incentives, because you're going to have to show that you didn't have too much material from anybody who's sort of contaminated by the FEOC-ness of their, chain of ownership and manufacturing. But again, there's thresholds of how much. It doesn't say you can't do it at all. Okay, it doesn't say you can't have any. It just sets limits to how much you can have to still get the incentive. And initially, those limits are pretty generous. In 2026, for a solar project, you can have 60% Chinese materials. So it can be mostly Chinese and still not be, banned on the basis of FEOC. But they get tighter. In 2027, it's 55%. Of course, in 2028, a project that starts in 2028, a PV project can't get any incentives at all. On the other hand, this also applies to other forms of generation. So if you were planning to build a nuclear power plant in 2030, you'd better not buy more than 40% Chinese materials or you won't get any incentives. And then the requirements on battery projects are much more stringent. They're 45% in 2026. So a lot of this is an effort to chase the Chinese out of the battery market. An important question is the expectation. Remember I said that the year you start a project, for purposes of the domestic content adder, the year you start a project is what counts. They haven't said explicitly whether the year you start a project is what determines what FEOC threshold you have to meet. The people who are experts at figuring out what the IRS is going to do think that they're going to apply the same rule, that the year you start a project is the year whose FEOC thresholds apply to your project. But there's no definitive ruling from the IRS to that effect. But in any case, since they get tighter, that's another reason to move faster. The FEOC has the same concept of a product can be partially FEOC in the same way that a product can be partially domestic. And by the end of this year, the IRS is going to publish a similar table about how you determine the composition of a product. For the moment, the permission is that you can use the same table that you use for domestic content, except we're kind of use it backwards. So here's an example I've worked out using that same table for a rooftop micro inverter example, except we're going to do it backwards, okay? In this example, I've assumed that I'm doing a project and I'm using Chinese solar panels. So everything was made in China. So I put a 1 for calculating the FEOC content for every fraction that's Chinese. And since it's assembled in China, I get a 1 here. And then let's assume that I'm using American inverters. Or for FEOC purposes, it doesn't have to be American, it just has to be not Chinese. So I put zeros all here. And since everything was not made in China and not assembled in China, I get a 0 for the inverter production. And by way of example, let's imagine that for the racking manufacturer used Chinese fasteners. So I get a 1 here, but the rails are domestic. Well, because there's a Chinese material went into it, I don't get to count the racking as domestic, so I get a 1 for the manufacturing. Everything is the inverse, right, of the domestic content. So in this example, which I sort of contrived, I come up with 60%. So this project is 60% FEOC materials. So in 2026, the FEOC maximum ratio is 60%. So this project would pass the FEOC test and be eligible for receiving incentives in this year because it didn't fail the test of being over 60% FEOC materials. Next year, in 2027, this project would be denied all incentives because next year, the maximum FEOC ratio is 55%. And if a project is 60% materials, this project would not be able to receive incentives at all. So again, another reason to get started sooner and hope that the IRS agrees that the year you start is what counts. Now, the FEOC threshold for batteries, remember I said that the battery incentives don't go away, but look at the FEOC incentives for batteries, the FEOC thresholds for batteries. FEOC thresholds for batteries start at 45% and go down and down. So another reason to start a project sooner, assuming that the IRS agrees that the year you start is what counts, is that you'll have a less onerous FEOC threshold. And this is from another table, a similar concept. The IRS publishes a table of, for battery projects, how they evaluate what fraction comes from what part of the project. But they have different tables for grid scale batteries and for distributed batteries, like you might use in a home or commercial solar battery project. For grid scale batteries, this is interesting. They've decided that the cells alone represent 52% of the value in a grid scale battery. And since the FEOC ratio is 45%, that means that no grid scale project can use Chinese cells. Right there, that excludes all grid scale projects from using Chinese cells. For a distributed system, their modeling says that, well, the cells are a much smaller fraction of the value of a distributed system. And so a quick calculation says that if I built a system with Chinese battery pack, that would be 43% FEOC materials. But if my inverter and my container were domestic, that would be 53% domestic, 57% domestic. So in 2026, a battery domestic, or a distributed battery system with Chinese battery pack and domestic inverter and container would be 43% FEOC. And so the ratio is 45%. So that passes, right, and below the maximum threshold of FEOC. Interestingly, since the domestic content ratio is 50%, this is 57%. If these two were domestic, I could count this as a domestic system and claim the domestic content ratio. Now, here's the interesting part. In 2027, the FEOC threshold goes down to 40%. So this conceptual system with 43% value in Chinese battery pack would no longer be qualified because it would fail the FEOC ratio. And if this was domestic content for the rest of it, we'd have the crazy situation that under the domestic content rules, this system is enough domestic content to qualify as being, it should be rewarded for being domestic and get a 10% bonus, but it's also being penalized for being foreign, from a foreign entity of concern, and therefore denied all incentives. So it's both domestic and foreign. This is the sort of the Schrodinger's battery pack design. So it gets that complicated. And in this case, the FEOC rule overrides all other rules. So in 2027, this imaginary system I made up would be denied all incentives for having 43% Chinese content. Anyway, so enough of that. Good news. Some good news. First of all, 100% bonus depreciation is restored. So anybody who's actually a tax-paying party can deduct the entire cost of a renewable energy project in the year the project goes live. Non-tax-paying entities can collect the entire incentive as a direct payment from the IRS. The one catch is that if it's a larger project in the sense of being above 1 megawatt, then they have to do domestic content or they lose the entire credit. So that's something to watch out for, especially if you're doing obviously a bigger project. Another important change, it used to be that in order to get the 30% incentive, batteries, or in this case 40% for most of us, batteries had to charge from solar. And there's a complex calculations you had to do to show that you had enough solar to charge the batteries. All of those restrictions are gone. You can just get batteries, get the incentive for the batteries. You don't have to do any argument about you're going to charge them for solar. And battery projects under 1 megawatt inverter power are also exempted from prevailing wage. And most importantly, batteries have a much longer time limit. The incentive for batteries is good until the end of 2033. So, conclusions. Biggest conclusion is very significant incentives are still available, but you have to move fast to do something about it. Any business or any institution can lock in the incentives for systems under 1.5 megawatts by spending 5% of the system cost just on planning and or buying some components before July 4th. You should think of this as being a way to reserve the tax credits because it allows you to hold it for 4.5 years. This kind of reverses the normal planning process. Most businesses, most organizations don't want to start a capital project until they know they have all the funds in hand, or at least pledged. But that's not wise financial planning in this environment, because if you don't act quickly, something that would pay for approximately half of your project is going to go away. So spending 5% now to reserve effectively 10 times as much is the smart thing to do. And, delaying and thinking about it and going, oh, I don't know, we don't know if we'll have enough money to do it in the next 4 years is poor thinking. So we're trying to get the message out to everybody who needs to do that. Keep in mind that we're talking about solar here. The incentive for batteries and geothermal lasts until 2033, so there's less urgency. Although there are, as I mentioned, some technical reasons why you might want to get a battery project on the books also. But the last thing I want to leave you with is the documentation is everything. You have to be able to provably document the start date if you want to do this. You need to document the completion date because there are drop dead dates, especially if you don't start before July 4th. Then the 2027 date is the date the project has to be fully operational. If you're going to claim domestic content, there's critical documentation you have to collect from your vendors, documenting the chain of where they got it and who made it. And they have to give you documentation showing that they have reasonable grounds to believe the validity of the documentation. The same for FEOC. You have to receive from vendors documentation that this material is not of Chinese origin, or if it's partially Chinese origin, documentation showing the ratios that you're going to use when you go to this table. And you have to save all of this stuff because the law allows clawbacks of incentives. So you could, years later have an audit and lose the incentive and have to return it if you don't save the documentation. So basically, there's a lot of money on the table. If you don't move fast, it's going to go away. But if you're going to do it, you have to do it carefully. And, CCE is trying to put up a program to help people do that. So feel free to reach out to me if you need help with this. And with that, I will stop and take questions.
Thank you for watching this presentation from the California Alliance for Community Energy. This concludes the published portion of our monthly call. If you would like to participate in our monthly calls, including Q&A, please consider joining the California Alliance for Community Energy. For more information, you can see our website at cacommunityenergy.org/apply.